Maybe you already heard this advice before. If you want to invest, just buy an ETF. Well, there's far more than meets the eye to ETFs, as we'll explore together with this trusty little onion here. I'm going to walk you through 10 common types of ETFs, so that after this video, you can make a really well-informed decision about what kind of ETF you would like to invest in and what kind of risk you're willing to carry. And towards the end of this video, I'll recommend a resource so that you can do some more in-depth research on the types of ETFs that you would like to buy. First, the basics. What is an ETF or an exchange-traded fund? ETFs are investment funds that you can trade on exchanges, just like you would with regular stocks. And they offer some cool advantages because they allow you to invest in a massive portfolio of stocks, bonds, commodities, whatever you'd like basically. And since they're operated by computers, they offer a very low cost diversification of your portfolio. By investing in an ETF that tracks a particular index, you can gain, for example, exposure to a broad range of companies or industries without having to purchase individual stocks. Since ETFs get traded like regular stocks, it also means that they're pretty liquid, right? If you want to sell them, you can easily sell them on the exchange. And the same goes for buying. They're readily available most of the time as well. They're operated by computers. That means that ETFs generally will ask for lower fees than manually managed funds. You get to keep more of the returns that your fund generates over time. But, and this is important, there are also risks attached to trading with ETFs, and that's not very often highlighted. So I would like to walk you through 10 most common types of ETFs, and I'll rank them from low risk to extreme high risk. And so you'll get to feel a little bit for what would be right for you. To do this, we're gonna peel back layer by layer of this onion. Okay, let's get started. So first, we've got the fixed income ETFs. So as the name indicates, fixed income, you kind of know what you're going to get out of them. So that's why they're considered pretty safe. They invest mostly in bonds and other types of fixed income securities. First layer goes off. Second type, we've got the style ETFs. Now, these ETFs invest in certain stocks based on investment styles, such as defensive or balanced or value-oriented or growth. So especially growth, for example, is a bit more aggressive. So depending on the style that you pick, this is going to be more or less risky. Let's continue with that onion here. Okay, it's going to be a real pity to keep cutting this onion and not capture everything in the little pot. So let me add a little container for this. Okay, the third type is the smart beta ETFs. And so first, maybe you're wondering, what the hell is a smart beta? So the computer behind an ETF is looking at the rule set to basically make a decision whether or not to invest in certain stocks or any other financial instruments. So they may consider a variety of weighted factors like volatility, liquidity, quality, value, size, momentum. And so these ETFs are explicitly designed to beat the market and to be also, of course, low cost. Pretty advantageous if you ask me, if you find one of the ones that performs really well. So that means next layer. Number 4, equity ETFs. These ETFs invest primarily in stocks, and as you can expect from anything investing in stocks, they can be pretty volatile, go up and down, and just as the market swings. There's not much else to add here, just a bit more risky than the previous ones. Look at that. I've got a bit of a weird onion here. There's like an extra growth here. So like an extra onion within the onion here. All good. Number 5. Let me try that again. So number 5, sector ETFs. These ETFs invest in specific sectors. Whatever you think would be an interesting sector to invest in, like healthcare or energy or technology or whatnot. And of course, the success of these ones will depend on how well the sector is doing. And that brings us already halfway our list. And if you're wondering, yes, bit by bit the onions starting to get up my nose a little bit, so we'll see how that goes further down in the video. Number 6, the real estate ETFs. Now these ETFs invest in mostly REITs. Since this is real estate, of course, this will be also pretty sensitive to however the real world economy is doing. From the moment that interest rates get hiked up or the general economy seems to be suffering, it's pretty likely that your real estate ETF will also be suffering. Personally, it's up to this type of ETF that I feel comfortable investing. And the following ones are a little bit riskier to me because also I don't understand them fully. I don't understand the underlying products as well as I do the ones up to here. But we'll still cover them so you can still make a decision for yourself as well. Number 7, currency ETFs. As the name indicates, these ones invest mostly in foreign currencies, which of course are subject to massive swings because of political and economic risks. This is more risk than I'm willing to take on for stomachs of steel only. Commodity ETFs at number 8. So these ETFs invest in physical commodities such as gold or silver or oil or copper or whatnot. Sometimes also in the futures contracts on those commodities. It makes that you can expect quite some price swings, and it's going to be very volatile if you hold one of these. And we're already at number 8 in this list, so the risk is really substantial at this point. And also we're getting to the end of this onion over here. Does this thing even have 10 layers? Yeah, it probably does. It's an onion. Number 9, inverse ETFs. These are already pretty exotic. These ETFs use financial derivatives to trade. And basically what they do with the financial derivatives is they look at contracts about underlying stocks or commodities or whatever you want to put a contract against, where one trader says to another trader like, hey, I think this stock will go up or down to this price, so I would like to reserve the option to buy it at this price and this date. That's most of the time it's going to be a similar system in variations for various derivatives. These derivatives are then used on the inverse ETFs to beat the market by betting on a market going down. This is already way riskier than traditional ETFs because basically you're betting on the market tanking. The last one on this list, number 10, the leveraged ETFs. Now these ETFs use financial derivatives like options or futures or swaps to amplify whatever is happening on the market. So they want to amplify the returns of a specific sector or a specific set of stocks. If the underlying asset goes up or down, you're getting a multiple of that, which can be either fantastic if it goes up for you, or absolutely disastrous when things go down. So this is the highest risk that I have here on my list. And this brings us also to the last peel of the onion I want to remove. And look at this. We actually get to a growth within the onion. This is kind of beautiful now. So, and at this point, I should also really take up a tissue. I'm pretty lucky actually that I wear glasses because that stops most of the juices from the onions to reach my eyes. So now you know about the typical ETFs types, and maybe you would like to do some more research on specific ones. And for this, I also have a handy resource for you. There's a couple of reliable databases online, but one of the best ones I found is etfdb.com. There's some really good ones as well, like Morningstar or Bloomberg Terminal, but they are locked behind a paywall, so that's not so interesting if you would like to do it low cost. So ETFdb.com is really good. I was impressed with the level of information that I found when I was just scrolling through. If you want to use a different one on Yahoo Finance, you also find a decent amount of information. So there you have it, 10 types of ETFs. I hope you found this video useful. And if you'd like to know more about how to start investing, I would recommend you also check out this video over here. Thank you so much for watching, and see you in the next one. Cheers.